How we doing, everybody? Today is Saturday, July the 15th, 2023. Just coming to you live for our training today on real estate note investing. We've done, this will be the third training in the series. If you want to go back and see the first two, you can go back on the YouTube channel at Abundant Capital Group and you'll see the first two episodes. And this is the third. And the first two, just to give you a quick overview, we talked about what is a note and why you would want to invest in real estate notes. And then today we're going to talk about, so you know what a note is and you've kind of researched it and you're thinking about, possibly investing in it. We're going to talk about the approaches, how you want to look at this, how you want to approach this, depending on who you are. And so we'll kind of go through that a little bit, and we'll get into the different types of notes as well. They pretty much broken down into about three different categories, and just depending on your objectives, you probably want to focus on one of the three categories or maybe a couple of the different categories that notes fall into, depending on what you'd like to accomplish in the note business. So again, we're just breaking this down piece by piece. We do this every Saturday, 12:30 Eastern time here on YouTube. If you, like I said, if you're not able to catch it live, you can always catch the replay. And we're just taking you through from A to Z, so to speak. So, and this is just a third training. Don't know how many total trainings there'll be, but it'll probably be somewhere between 10 to 15 probably trainings that'll break it down. We usually we're not here that long. We try to keep these short and not too long. So within about half an hour or less. So hopefully people will go back and, kind of go through the series and see why they should look into note investing. And this is for anyone, if you are looking to invest, if you're looking to buy, if you're a realtor, if you're already an investor, you want to, know about notes and make that a part of your investment strategy. If you are in real estate, because of all the benefits, which, we'll continue to talk about as we kind of go through the series. So when you've made a decision that, I'm thinking about getting into notes and, I want to invest in it, you have to look at it from like two ways. Are you going to be an active investor, or are you going to be a passive investor? Some people, work, have jobs, like their jobs and, make a certain amount of money and want to take some of that money to invest, whether it be through their retirement account or, any other, types of funds that they have to invest in real estate. So if you're somebody like that has a 9 to 5, you probably want to take more of a passive approach to investing in real estate notes. Now, if you're somebody who's already in real estate, been an investor for a long time, this is kind of your, quote unquote job or your focus, you may want to take more of an active approach to note investing. So when we say passive, it means that you're not, as involved on a day-to-day basis. Obviously, you're always watching your investments and what you invest in, but you don't have to, maybe be concerned about it every single day. Maybe once a week, once every couple of weeks, you kind of check in on things to make sure that, the payments are coming in from the person that's in the property, because you, as the note holder, you're the bank now. So you're just making sure that those payments get collected. So you probably, may only need to look at that maybe once a month, make sure that it's coming in. And that's someone, who doesn't have as much time to focus on, the day-to-day and keeping up with things on a day-to-day basis. So that's the passive side of it. The active side of it, again, is somebody that's probably an investor, somebody that does fix and flips or owns a portfolio of real estate and other investments. They want to be more active. So if you're, where it's more on a everyday type of basis, that you're looking for opportunities, assessing opportunities, and managing, the opportunities once you do purchase the note. So, with that being said, there are three types, and the three types of notes are you have non-performing notes, meaning that someone is in the property and is not making payments on that, for that property while they're staying there. They're behind. It could be 1 month, could be 6 months, could be a year, whatever the case may be. But that falls into a non-performing note status. So you have the opportunity to purchase these. And we discussed in some of the previous trainings, like where this inventory, comes from. So definitely go back and check at least last week's training. And it talks about where this inventory, kind of comes from. So it'll fall into this non-performing status. Then you have what we call sub-performing or reperforming, meaning that for sub-performing, just meaning that, they may make a payment good for 6 months for the first year, then maybe year two, they may, they missed a month, kind of made up for it, the second month, maybe made half a payment, 2 or 3 months down the line. So it's kind of like what you call a spotty pay history. So that's what we call sub-performing, meaning that, you are technically collecting the payments. It's just that maybe they're not coming in exactly when they're supposed to come in, or there's a missed payment here and somebody's making up. And then also what we have are reperforming, meaning that the person fell into a non-performing status at one point, but due to a modification, due to some type of workout with whoever owned the note, they've gotten themselves back on track and have shown to make payments consistently. Now, how long they've been reperforming is something that you'll have to find out, that we have to look into, because someone will have a non-performing note and be able to restructure it and get the person paying, but maybe they've only made one payment, and they may now present that to be sold as a reperforming loan. Technically, is it? I mean, it could be up for debate, but technically it is. They've made the payment. They've gotten back on the schedule for at least this first payment, and we'll see how things move forward. So it really just depends on how you as the investor define a reperforming note. Some people will look at it and say, okay, they're back on track after making one payment. Some people may want to see 3 months, 4 months of payments before they consider that to be reperforming. It really just depends on the person and some other factors that we could look into to see how much was this modified based on what it is that the person is bringing in now. Was their situation based on a job loss, or was it something else that happened in their life that caused them to kind of get off track? Maybe you'll feel more comfortable knowing that, and then just making the one payment. You'll say, okay, maybe they had this scenario that was unforeseen and things got restructured, and you feel confident that the person can go forward and make payments. But that's an individual type of thing where, based on, your comfort level and how you see things and what makes you feel, comfortable. You could say 1 month, it could be 2 months. Maybe you want to see 6 months. It's just really up to you. So, and then the last category that these fall into are performing. That means that the person who's living in the property is paying, as scheduled, if it's whether it's due on the 1st or the 15th of the month, when that time period comes, they're paying, and they're paying on time. So when you have those three, and then you figure out, what it is that, how you want to present yourself or how you would like to invest in these opportunities, I would say as a person that wants to be a passive investor, you probably want to focus, number one, on the performing notes. That means that, that payment is coming in. It's really not going to take too much, effort on your part. You just know that, the 1st of the month or the 15th of the month, whenever that payment is due, it should be coming to you once you purchase it. So you don't really have to worry about anything. So if you're a passive investor, you probably want to focus there initially. getting into the business. Now, as you purchase notes and, maybe things change for yourself, maybe you switch over and do become a little bit more active. But if you have made a decision to be passive, I think that, you want to start at those performing notes. And then you also want to look at maybe the reperforming. And then again, based on, your comfort level, your risk tolerance, so to speak, how do you define reperforming? Because there are reperforming loans out there that somebody's been paying for a year. They had an issue, especially now coming out of COVID. You might see that, people during that particular time, that 1 to 2 year period, had an issue. But now, 12 months, 18 months out of that pandemic, they've been able to make the payment. And a lot of statistics show that based on what was done during the pandemic, people that, didn't pay at those particular times, there's a high rate of them that have, started to get back on track and make payments. So, as a passive person, probably want to focus on those two. Potentially, you could focus on the sub-performing as well, but that's probably going to take a little bit more of your time, just to be following up and making sure that, or keeping up with the person. You don't know when they may miss that payment, when they may skip a payment, or something like that. So you may not want to, focus on that initially. Maybe down the line, again, as you get more comfortable, you can then take on that. But initially, you want to look at the performing and the reperforming. As an active investor, you can look at all three categories because, you have the time, you have the wherewithal to kind of keep up on all of these situations, no matter what they are. So, you can definitely look at all three. Let's see. What else do I want to talk about here? Got the two approaches. And then also, when it comes to if you're an active investor and let's say there's a non-performing note where the borrower goes into bankruptcy, you don't necessarily want to shy away from those. Depending on, which bankruptcy is, we won't get into the specifics, but depending on the type of bankruptcy, you're either going to get a readjustment on the person in the property and them being able to make the payment. They look at their debt, they get rid of certain things. The person wants to keep their house, so they can restructure that payment. So you're going to, if you own that, you're going to start to get repaid depending on, that particular filing of bankruptcy. So, don't let that necessarily scare you off from opportunities, because if that is the case, and we're going to go through each bankruptcy at another time. I don't want to go into that this early, but that's going to get restructured, and you're, as a note owner, are going to get paid. A lot of times people will say, oh, they get bankruptcy, they just think the worst, but it's not necessarily the case. And then let's just say that the person goes into a different type of foreclosure where they just can't afford it. You have a better opportunity of getting that property back. As part of that type of bankruptcy, the owner of the home is going to sign it over to who the lender is at that particular time. So you've essentially purchased that property for whatever it is that you bought the note for that amount. And as long as you purchased it correctly in relation to the market value of the property, then you can do whatever it is that you want at that particular time. Now, the only downside with that is that depending on the state and bankruptcy laws and rules and things like that, it could be some time before you're able to, get things worked out. In the first scenario where there's a restructuring, that may happen, a lot quicker than maybe the person, signing off the property to you, because they could be, playing the system, so to speak, or something like that. But if you have the wherewithal to manage that and manage the time frame, understand the time frame based on the state, it's still a good opportunity, and it shouldn't, scare you off, so to speak, from that particular opportunity. Also, as a passive investor, you want to, probably focus on the consumer created seller financing, those quote unquote what we call mom and pop notes that were created. Um, Now, you may not be the person that reaches out to them directly with mailings and things of that nature, but you can kind of focus on the seller finance notes that were created by quote unquote mom and pops that are performing. So you could do that as well. And, we could help you if you wanted to market to those. There are some strategies out there where you can be direct to those people and get to those people and, start to focus on getting those types of opportunities. So that's something that, again, that we talked about in the last week's training, where this inventory is. So you could, focus on, trying to reach out to those people, or work with someone that reaches out to those people and try to buy those quote unquote mom and pop performing loans that, as your strategy. So I'm just checking out my notes here, see if I left anything out. Again, as an active investor, when you do the non-performing, the reason why the passive investor doesn't really want to do the non-performing because like you have to do a modification. It takes communication, either with a third-party servicer or yourself and that particular borrower. So when you kind of reach out to them and you want to modify the loan, you may not have the time or the energy to kind of, after work, make those phone calls, follow up, and do all that other stuff. But somebody that's active, they have the time to do that, to get on the phone with the servicer, try to figure out, what can we do here? Can we lower this particular person's payment? Sometimes $100, $200 saving a person gets them right back on track. And then once you look at what the new payment is based on, collecting that over the next 12 months, based on what you put into the property, you can see, a really good return on your investment. So, and then once you do that, once you get that kind of rehabbed, get that repaired, there's a lot of options at that particular time too. Once you've taken a non-performing loan and got the person repaying, there's some options that you can do as well, and that will take someone who has more time to give towards doing those particular strategies at that particular time. Won't get into those specific things at this point. That's something that does come later. Some of these what we call exit strategies. We'll kind of get into that later on. So, but just for today, we wanted to just now that you've been thinking about it, you want to take the next step. The next step is to figure out how you want to approach this particular business. Do you want to be passive or do you want to be active? And then you have to think about your risk tolerance, kind of figure out what you feel comfortable doing and not doing. This way, what you can focus on in terms of the three types. Four types technically, but on which one of those that you want to focus on based on, your time and your tolerance, risk tolerance that you have for investing. So, that's what today's training is. Like I said, training is about today. We don't keep you long. We're just trying to take this piece by piece, bit by bit, and walking you through, how you want to approach this, why you want to do it. And, we'll kind of get into the nuts and bolts of looking at documentation, how you evaluate things and stuff like that, the different exit strategies. We'll kind of get into that as we go on. But for today, we just wanted to kind of go through the approaches that you would like to take. If you're going to get into this business and on the, the amount of time that you have for this, and, what you can, the types of notes that you can invest in based on your time that you have to get to this business. Also, the amount of money that you have as well. You can look at that and see where's the best place where you can fit in. So we're here again next Saturday, 12:30 Eastern time on this YouTube channel, as well as we are on Instagram as well. We go there live. So if you have the time, join us here 12:30 Eastern time. If you have any questions based on the training today, you can post them in the comments here on YouTube or on Instagram at Abundant Capital Group. We'll get those answered for you, but we'll be back next week and we'll take the next step, in the training of in real estate notes and real estate note investing. So we'll see everybody next week, 12:30 Eastern time, right here, same place, same channel. Have a good one.